Hello, smart people. How are you today? We just wrapped up a class on the tech sector for a really prestigious global law firm. And the aim of this class was to help their lawyers understand their tech clients better so they could really be smart strategic advisors. And by the way, did you know that fancy law firms are called white shoe firms? I don't understand why, because nobody there was actually wearing white shoes. But anyway, one of the things that we covered in the class was tech investing trends. So what are investors investing in and what are they staying away from? And we were teaching corporate lawyers, which is not the target audience of this podcast, but the insights are directly relevant for you if you're building a tech product or if you're leading innovation inside a company. Because if you want your CFO or an investor to invest in your project, you need to know what they're thinking. So let's start with the AI issue. It's kind of big, right? Are we in a bubble? Is the bubble about to burst? Well, I would say that we're kind of in a more discerning phase of the AI cycle than we were about 6 months ago. And the tech investing world has basically split into two camps. So there's one camp that believes that AI is going to replace everything. And then there's another camp that believes that AI is just a feature, not a product. And this is kind of the more discerning phase of the cycle where we kind of previously had people who were saying, oh, AI is going to change everything. And then we had some people who were saying AI is going to change nothing. So I think we've moved on to a slightly more sophisticated understanding. And so today I'm going to talk to you about the 4 tech investing trends in AI. Number 1, vertical AI is winning over horizontal AI. What does this mean? Well, basically, unless you already run OpenAI or unless you already run Anthropic, investors don't want AI for everything anymore. You have to have a niche. So they want AI for lawyers or AI for supply chains. They want specificity. And, as my American listeners say, the riches are in the niches. And that's niches for the Brits. And here's why. Basically, if your pitch is we use ChatGPT's API to solve this problem, the immediate question from any investor is, well, what's going to stop somebody else doing exactly the same thing tomorrow? Like, do you have a moat? And by the way, if you just heard API and you don't understand what that is, that's fine. Nobody's born knowing it. But it is an important concept, so you should know it. And I created a video about it on YouTube, which is linked in the show notes. Anyway, if you're in a position where investors are asking, what's going to stop your competitor from doing exactly the same thing tomorrow? Where is your moat? You have a defensibility problem. And that defensibility problem is getting harder and harder to answer these days. So let's look at the numbers because the paradox is really brutal. So it's now 90% cheaper to build AI products than it was just 2 years ago. That's insane. Like, what insane technological growth. What an age we're living in. So that's amazing. The barriers to entry have really collapsed, and you can spin up an AI-powered app in days using tools that just didn't exist in 2023. But, and this is critical, it is significantly harder to convince investors that you have sustainable competitive advantage. So one thing got easier, one thing got harder. Costs went down, but defensibility became the number one question. So yes, with the age of AI, business is still hard. Basically, if you can't answer the defensibility question, you are not going to get funded. Unless, obviously, you have the magical persuasion powers of WeWork founder Adam Newman, who managed to convince investors that an office building was a tech company. I mean, I can't do that. I don't have those powers. And so just assume that you don't either. Anyway, this is why vertical AI is winning. Because when you say, I am building this AI solution which solves this problem for lawyers, you're not just slapping ChatGPT onto a problem. You're building something that understands a specific workflow. You're building something that maybe understands regulations and edge cases of that specific industry. And also, when you're talking about a specific industry, a specific target customer, you're also selling a go-to-market strategy. And by the way, we have a really good lesson on go-to-market strategy coming up. But when you're selling a go-to-market strategy to investors, you're basically saying, I know how to sell to lawyers, and I have a marketing plan to attract them. And this is defensible. This takes time, and this takes domain expertise to replicate. This takes relationships. And this is why investors are more into it than, okay, I'm doing this thing for everybody. So basically, if you're building something with AI right now, ask yourself, am I building for a specific vertical, or am I trying to be everything to everyone? Because everything to everyone is not a good idea unless you are basically already Sam Altman. There is going to be more M&A and fewer IPOs. This is the third trend that we're seeing. We're seeing that big tech is acquiring startups rather than letting them go public. And a trend that has really been accelerating for a while is that companies are staying private longer than ever before. So previously, companies would get to a certain level of funding rounds and then they would list their shares on the stock exchange, and that's called an IPO. That's actually happening less. And now companies are staying private for longer and then basically getting bought out. So we're seeing companies that would have gone public 5 years ago, they're getting acquired or they're planning to get acquired. And another thing that we're seeing literally from all the market predictions is that 2026 is predicted to be a big year for M&A. And if you are at a later stage, or if you're already talking to investors and investors want to know about your exit strategy, which is a really standard thing for them to ask about, basically you just need to know that the M&A predicted boom is going to change your exit strategy, because it changes the type of investors that you should be targeting from day one. Because if you're building with the assumption that you're going to list your shares on the stock exchange to IPO, but then in reality, the market reality is that you're probably going to get acquired, there are different investors that want these types of things. So you need investors who understand M&A exits. So if you're speaking to investors and you can literally say to them, okay, how many of your companies that have been in your portfolio have been acquired by a larger firm? Do you have relationships with acquirers? Because, VCs want you to get sold. And if they have relationships with potential strategic acquirers in your market, then yeah, maybe they deserve a discount, or at least, basically be nicer to them. So basically, this is not just a headline. This is something that affects your fundraising strategy, your cap table, and ultimately your outcome. It also affects who maybe you want to have on your advisory board. If you are thinking, okay, what we're going to have is a strategic acquisition, so we're going to have a big company in our sector buy us, you want them to know about you. You want, when you're at a certain level, you want them to know that you exist, which means getting into some sort of relationship with them, maybe having some of them on your advisory board, maybe having them invest in you. Maybe that investment is going to be money plus some sort of deal, which is then going to lead to an acquisition. Trend 4 is that deal terms are getting more complex. And this is really dangerous if you're not paying attention, because, there are convertible notes, there are safes, there are liquidation preferences, there's drag and tag, participating preferred. Literally, there are so many terms. And these financing structures, they've become so intricate that many founders don't really understand what they're signing. And unfortunately, met founders who didn't understand what they were signing and got completely screwed as a result. So this is not just a legal issue. This is literally like, how much money do you get in your pocket? So because you can raise money and then you can feel like, yes, you've won. And then later you can realize that the terms that you signed basically mean that you don't make anything, or you make much less because of some stupid thing that you basically overlooked. So I've seen founders raise millions of dollars and then find out that because of some kind of liquidation preference, they're going to walk away with much less unless the company exits at a massive, massive valuation. So basically, if you are going to raise money, you have to learn this stuff. It is serious. It doesn't feel exciting because it's kind of like legal and financial terms, but it's not going to be boring when you realize you've lost a load of money because you didn't bother learning the stuff. So you need to understand what market standard deal terms look like today. And there's actually a founder who came on this very show who shared about how he lost $500,000 because he didn't understand something in his contract when he sold his company. And it just seemed like a really tiny, tiny rule that just didn't really mean anything. But when he sold his company, okay, that's when he lost a lot of money. So listen to the gory details in episode 213, how not to sell your company. And we've also linked it in the show notes. So this is one of those areas where you genuinely cannot afford to be ignorant. You need advisors, you need people who have done this before, people who are on your side, because these decisions are permanent and sometimes they're impossible to fix.